to another Financial Glass update video. I'm William Glass, and I recently read The Secrets of Sand Hill Road by Scott Kupor, which is on venture capital and how to get it. Hey Siri, define venture capital.
Venture capital means capital invested in a project in which there is a substantial element of risk, typically a new or expanding business.
And Scott does a really, really good job explaining venture capital in and out, very easy to digest, and also provides a lot of really great insight into this kind of seemingly black box for folks on the outside looking in. So Scott works over at Andreessen Horowitz and was one of the first employees that they had. And Andreessen Horowitz, for those that aren't familiar, is a really famous venture capital firm. They have invested in Instagram, in Airbnb, in Facebook, Box, Zynga, just to name a few. So they're very successful, have a really big name, big reputation, and The Secrets of Sand Hill Road. Sand Hill Road, for those that don't know, is a famous road out in Silicon Valley where all the venture capitalists, big name venture capitalists, have offices. So I highly recommend this book if you are a founder interested in venture capital. It really goes into great detail, and it's very easy to digest about things within VC that you wouldn't normally think about. So, for example, I think one of the key things that I took away was really thinking about the incentives and promises that the venture capitalists have made to their investors, right? The venture capitalists are using other people's money to fund you. Yes, they probably have some of their own money in the funds, but at the end of the day, the majority of that money is actually from other large investors, so such as college endowment funds, pension funds, those types of large institutions, even hedge funds, that are looking for an outsized return on their capital. So with that, there's certain terms that come with giving them the money. It's not just, hey, here's whatever amount of money, like have fun. There's different funds that are raised that have certain time horizons, certain barriers in terms of what the venture capitalists are allowed to invest in. Hey Siri, define fund.
As a noun, it means a sum of money saved or made available for a particular purpose.
All of that is really, really important when you think about who you're going to reach out to if you're an entrepreneur, in terms of, who should you target? So-and-so just raised a fund, or this is at the end of life fund. Those things really matter, right? So if you are one of the first companies that receives investment, you likely have a longer time horizon with a little less pressure from the venture capitalists to return that money that they've received from their investors back to them, which affects their relationship with you as a founder. So all that's really important. If you wait till the end of life, there might be more expectations to quickly return capital and quickly grow that may or may not be suited for where your company is at the time. So these are all things that you wouldn't necessarily think about. I know I didn't personally when I was first starting to have conversations with venture capitalists. I was aware that there were these funds and there are certain things that I should be aware, but I didn't really know, right? I just knew, hey, certain VCs invest in certain things, but that was kind of it. Scott does a really good job going in depth into the incentives and time horizons that VCs are looking into. I think the other piece that I found really helpful is that oftentimes we get stuck on the valuations. Well, how much equity am I giving away? What's the dollar value? Without really thinking about the terms of the investment. Hey Siri, define term.
As a noun, it means conditions under which an action may be undertaken or agreement reached, stipulated or agreed upon requirements.
And so Scott goes into great detail about the term sheet, which highlights exactly what those other riders and things are, how disputes will be held, how the board will be controlled, how capital is returned on the next round, all that stuff that is actually really, really important, but usually you don't think about or discuss until you've presented with a term sheet from a venture capitalist. So those are really, really, I think, valuable pieces. And then the last thing that I found really interesting is that companies are staying private a lot longer. So it used to be that companies would IPO, meaning they would do an initial public offering to become publicly traded on a stock exchange. In about 5 years or so. During the dot-com bubble, that was even less, but on average, somewhere around 4, 5, 6 years. Now it's upwards of 10. And why that matters is that those large institutional investors, hedge funds, college endowments, retirement funds, used to just buy companies when they IPO'd, when they were smaller, and they would have those same kind of returns. But now, because companies are staying private longer, there's so much more money in the private markets. Companies that would have to go public to raise these large sums to continue to grow don't have to. But that also means that these other institutions are now chasing those returns, so they're getting into venture capital. So it's kind of this feedback loop that's occurring, where if you're a retail investor, like Facebook since its IPO, I think has at least 4x'd, which is great, but it's not what used to happen. But if Facebook would have IPO'd, when companies normally would have 5 or 6 years into it. So these are just really interesting, just nuances of how venture capital and the investment markets, capital markets have changed. So Scott Kupor's book is a really, really good read, and I recommend anyone that's an entrepreneur read it. It's just great in terms of understanding capital investors, regardless of whether you're in technology or not. Venture capitalists aren't exclusively in technology, software, and hardware. They do a lot of other things too. So anyway, I highly recommend it. It's an easy read. There's a little bit of math in there at certain points. But overall, it's a very, very simple, easy to digest book that will give you really great perspective on venture capital and the incentives behind it, which will help you as a founder. So hope you've enjoyed today's conversation around Scott Kupor's book. Please subscribe on either YouTube or Facebook, Instagram, follow the site, whatever you please, whatever's easier for you, and let me know your thoughts. Thanks for watching, and have a good one.